Welcome to this, the first in our line of videos explaining various aspects, tools and strategies for online trading. These guides won't give you an endless string of profits, but what they will do is highlight key aspects of trading and the tools available to help you avoid costly mistakes. In the first of these videos, we're going to talk about stop-loss orders, what they are, why you should use them, and how to use them effectively. So, what is a stop-loss? A stop-loss is an order that you can attach to your trade which will close out your position when it reaches a certain price. A stop-loss order is designed to limit losses on a position. It's always important to have a risk-reward ratio before you enter any trade, so you can establish that the trade has the right setup. Before you enter into any trade, you should have worked out your risk-reward ratio and ensure it's in your favour. There's no point risking 10% to make 5%. Really, you always want to be targeting a profit bigger than your risk. It's very hard to have a risk-reward profile on a trade if you have no stop-loss. Stop-losses can be used whether you're in a long position or a short position. For example, you may decide to set a stop-loss on your open position 10% below the current price. So suppose Barclays is trading at 200 pence and you have a buy position. Then you'd set your stop-loss at 180 pence. On the other hand, supposing you had a short position on Barclays at 200 pence, so you believe that the price of Barclays will decline. Then your stop-loss would be placed above the trade price at, say, 220 pence, for example. To be a successful trader, risk management is an absolute must. With the placing of any position, there will be a target expectation to the upside, and it's human nature to focus on this more so than the downside. However, there's also a level that will mean the trade is no longer the trade that you initially thought it was. And this is where the use of stop-loss orders becomes critical to your success. No one likes taking losses or triggering stop-loss orders, but the reality is they are there as your safety net. The reason for this is it also means that if the share price has dropped, you can come away from it and re-evaluate your position. Perhaps even look for a better, lower entry point, or just walk away entirely. Stop-loss orders are much like a parachute in the fact that it's better to have it and not need it than need it and not have it. Without a doubt, one of the key advantages of using a standard stop-loss is it's free. There is no extra cost involved when using a standard stop-loss. So it's like a free insurance policy. The other notable advantage of a stop-loss is that you don't have to watch your position tick by tick. Often, when traders place a trade without a stop-loss, they'll sit and watch the position on their screen and try to decide when to close it out if it goes too far into a loss. The problem with this is, firstly, the amount of time that's needed to sit there and watch the position. And secondly, any decision taken surrounding that position will almost certainly be emotional rather than part of a logical trading plan. Using a stop-loss encourages you to plan your trade properly, to think carefully about what you're willing to risk on the position, and also to assess the structure of the market and your trade. Using support and resistance levels in the market can be useful. These are levels which have proved to be important previously to the market. Moving averages can also provide guidance on where to leave a stop-loss. If the stock you're trading often bounces off the 50-day moving average, for example, then maybe set your stop-loss just below the 50-day moving average if you're long, and just above the moving average if you're short. Now, one of the downsides to using stop-losses can be slippage. Remember, your stop-loss is a market order, and this means that it will be filled at the level that the market trades at, which may not necessarily be at the level that you leave the order. For example, you have a buy position and you leave your stop-loss at 100 pence. Suppose that the market is falling very quickly and trades at 103 pence, 102 pence, and then suddenly slips to 97 pence, your stop loss would be filled at 97 pence, even though you left the stop loss order at 100 pence. Now, this is more likely to happen in less liquid markets or in very fast moving markets. If the market you're trading in moves this fast, then you need to reevaluate the market, reevaluate the trade size you're using, and of course the risk reward on your trade. The way to avoid this slippage is by using a guaranteed stop loss. Now, a guaranteed stop loss is like a standard stop loss, except that you are guaranteed to be closed out at the exact level that you left your stop loss at. Of course, you do, however, pay a premium for this service. The charge for the guaranteed stop loss is only taken if the stop loss is hit. So when trying to decide whether to use a stop loss or a guaranteed stop loss, it's important to consider the market, how quickly it moves, whether there is any big or new announcement due. So this is really where a stop loss comes into its own. Once you have a decent profit on your trade, but you feel there is more room to profit, so move your stop loss up to lock in some profit on the trade. Now, this is a key strategy for those professional traders, as it does allow you to let the trade run, but ultimately know that you've managed your risk and locked in some profit. This can be a great way to get more out of a trade and is often overlooked when people are using stop losses. So I hope this video has been of some help and gives you an idea about what a stop loss is and how to use it effectively. Good luck with your trading and your trading journey, and look out for our next video in this series.